Hello everyone, this is Across Univer. This week, the global capital markets experienced a Black Friday. After the Federal Reserve chose not to cut interest rates on Wednesday, the release of economic and employment data in the U.S. triggered pessimism among investors. Thursday's ISM manufacturing PMI for July showed the largest contraction in 8 months, and Friday's non-farm payroll data was weak, with the unemployment rate rising further, marking the worst non-farm report since the pandemic. These factors significantly heightened concerns about a U.S. economic recession and led investors to believe that the Fed's delay in cutting rates was a mistake, sparking large-scale risk aversion. Investors in the U.S., Europe, and Japan sold off stocks and flocked to U.S. Treasury bonds, causing a sharp drop in Treasury yields. Following the poor non-farm payroll data on Friday, the 3 major U.S. stock indices fell, with the S&P 500 index down 1.84%, the Dow Jones Industrial Average down 1.51%, and the Nasdaq Composite down 2.4%, having cumulatively dropped over 10% from its early July peak, entering correction territory. Tech stocks were particularly hard hit, with Intel's stock plummeting 26%. Among the Magnificent Seven, only Apple saw a slight increase, while the rest all declined. Amazon's stock dropped 8.8% after its profit outlook fell short of Wall Street expectations. Microsoft and Meta both fell by 2%. The market capitalization of the 7 tech giants has collectively evaporated by an astonishing $2.3 trillion since early July. Small-cap stocks also took a hit, with the Russell 2000 index falling 3.52% on Friday and down 6.67% for the week. Earlier, the expectation of interest rate cuts had driven significant funds into small-cap stocks, but now the deteriorating economic outlook is causing investors to pull out. In the Asian trading session, Japanese stocks led the way in crashing on Friday. Concerns about a U.S. economic recession, coupled with the Bank of Japan's interest rate hike and yen appreciation, led to a nearly 6% drop in the Nikkei 225 index, the largest single-day decline since 2016. Japanese tech companies such as Tokyo Electron, SoftBank, Lasertech, and Advantest saw significant stock price drops. Analysts noted that high-leverage Japanese retail investors rushed to sell the popular Nomura NF Nikkei 225 ETF, pushing its closing price down by 11.46% on Friday, further accelerating the crash in Japanese stocks. The Bank of Japan decided to raise interest rates and reduce government bond purchases in its monetary policy meeting on Wednesday. Bank of Japan. Governor Kazuo Ueda indicated that given the risks of rising inflation, another rate hike this year could not be ruled out. This led to a stronger yen, which quickly dampened expectations of increased profits for export companies, impacting Japanese exporters. In the European trading session, European stocks also collapsed, with the Euro Stoxx 600 index falling 2.7% on Friday. Under these circumstances, investors flocked to U.S. Treasury bonds, driving a 6% rise in ETFs tracking U.S. Treasury bonds this week. Investors are betting that the Federal Reserve will be forced to significantly cut rates to counteract economic weakness, pushing Treasury yields sharply lower. The yield on the rate-sensitive 2-year Treasury note fell by 30 basis points, and the 10-year Treasury yield fell by 18 basis points, both reaching their lowest levels since December last year. T.S. Lombard chief economist Stephen Blitz said that the Federal Reserve's decision not to cut rates on Wednesday proved to be a mistake. Investors now expect the Federal Reserve to cut rates by 100 basis points by the end of this year, meaning at least one of the remaining 3 meetings this year will see a 50 basis point cut. Rick Reeder, global chief investment officer of fixed income at BlackRock, stated that the Fed might need to cut rates by 50 basis points in September, as rate-sensitive economic sectors such as small businesses and low-income consumers are suffering losses. This series of market fluctuations also significantly impacts the Chinese market. Changes in Federal Reserve policy and dollar fluctuations often affect the yuan exchange rate and China's export competitiveness. A weaker dollar could lead to yuan appreciation, which is unfavorable for Chinese exporters as it increases export costs and reduces profits. If you enjoy my channel, please like, subscribe, and hit the notification bell. Thank you for your support, and see you next time.